What's best describe the purpose of life insurance? A, to accumulate wealth for retirement. B, provide financial protection to beneficiaries in the event of the insurer's death. C, to offer tax-free investment opportunities. D, to increase the insurer's net worth. What y'all think? B.
B.
That's right, B. Also, if y'all taking notes, you can also, sometimes everybody have it worded on the test. In North Carolina, they like to be real tricky. You can say to create an estate. The purpose of life insurance is to create an estate.
Create an estate.
Which of the following factors is not considered when determining life insurance premiums? So A is age of insured, B, health status, C, marital status, D, occupation.
D.
Nope, the answer is C, marital status. Yeah, so also you got, now what if they have this same question worded differently, if they say, which of the following factors does, or they can say, which factors is used determining life insurance, and they could say age of insured, health status, marital status, occupation. They could say like A, B, and D, B and D, C only, or A only. You know, they just can work. See, they can take a simple question like this and make it sound tricky. But all you need to know is marital status ain't got anything to do with you getting insurance or not. Got it?
Got it.
Okay.
Individual applies for a life insurance policy and pays the first premium. What is this considered? A conditional contract, B, a unilateral contract, C, an offer and acceptance, or D, representation. Going once, going twice.
Wait a minute. B?
C.
No, it's C.
Often.
Okay.
When a person applies for life insurance and they pay their first month's premium, that's considered an offer. Like you are off when you pay your premium $50 to the insurance company, plus you do your application, that's an offer. Then the insurance company has to accept your application, and that's when your coverage starts. Got it?
Oh.
So so y'all got to remember this now. The application and the premium together is the offer. So it sounds like, to me, it sounds backwards. Like it seems like the company would be making the offer, like offer you to buy something, but it's actually the opposite. The client, the applicant, the person who's trying to get some insurance, when they submit their application and they pay their premium, that's the offer. And then when the insurance company accepts it, approves the application, that's called acceptance. Got it? Next question. The two primary types of life insurance are A, permanent and term, whole life and universal life, renewable and convertible, participating and non-participating. Going once, going twice.
B.
Bam. Let's go. You right. Whole life. Permanent and term. Good job. A policy that provides coverage for a specific period and does not bill cash value.
Coach, hold on. Go back to the previous question. Is it A or B?
A.
Okay, because you said B. I'm just making sure for training purposes.
Oh, my fault. Did I say B?
Yeah.
Lord, I'll be tripping. Permanent and term is A. The answer.
Permanent and term, okay.
Is the two types of life insurance. A policy that provides coverage for a specific period and does not bill cash value is called A, whole life, B, term life, C, variable life, D, universal life.
C.
It's B. Term life.
B, term life. Yes.
Okay.
The least expensive, most coverage for the least amount of money, you coverage for a term period of time. You see in the question where it says specific period,
Mm-hmm.
what's term? A term is a specific period. Baby, a woman gets pregnant, having a baby, the term is 9 months. So a specific period is term. Those words are interchangeable. If you ever see specific period, the answer is term. If you ever see the word term in the question, the answer is specific period. Got it?
Okay.
Got it.
Oh, now I can't read the question. There's something that provision that allows a policy owner to reinstate a lapsed policy under certain conditions. Forgive this formatting, it's terrible. The answer is
B.
reinstatement.
Yeah, reinstatement provision.
Because is it the answer to the question is in the question. It says which provision allows the policy owner to reinstate, and the 4 choices are incontestability, reinstatement, waiver of premium, a non-forfeiture option. The answer obviously is reinstatement because the answer to the question is in the question. So whenever you see that, you ain't gotta overthink it. Just choose that and go on to the next one. The incontestability clause in a life insurance policy, A, prevents an insurer from contesting a claim due to misrepresentation after a set period. B, allows the policyholder to take a loan against the policy's cash value. C, guarantees the policy will not lapse due to non-payment. D, provides additional death benefits in the event of accidental death.
C.
A.
Who said A?
I did.
The answer is A. Once again, you see the question
Oh, I see it.
is
It's in
in
the question.
the answer to the question is in the question. The
Incontestability
incontestability clause
after.
prevents an insurer from contesting. Contesting means challenging, meaning they can look for a reason to deny the claim. So the incontestability period in life insurance is anytime after 2 years. So if somebody apply for life insurance
2 years.
and they die within 2 years, the insurance company can go check that application, make sure all the information was true, make sure that they ain't, did nothing slide through the cracks before they pay that claim. But after 2 years, the policy is incontestable, meaning they could have lied on the application. They could have been a smoker and overweight and 5 medication they didn't mention, but the insurance company didn't catch it. They still got to pay. Got it?
Got it.
Yep.
What is this? Something policyholder has a grace period to pay premiums before lapse. So the policy provision that allows the policyholder to have a grace period before the policy lapse. A, waiver of premium. B, automatic premium loan. C, grace period. D, free look period.
C.
C.
C, grace period. Got it. Something to continue coverage, I guess, is the policy provision that allows a policyholder to continue coverage without paying premium if they become disabled. You gotta know this because it's gonna be on the test 5 times. The policy provision that allows you to continue coverage without paying your premium if you become disabled is A, it says guaranteed insurability rider. B, waiver of premium. C, accidental death rider. Or D, pay your benefit.
B.
B? Who said B?
I said B, Natalie. The
Nat
waiver.
Natalie act like she knows something about some life insurance around here. You exactly right. The answer is B.
Oh, thought it was wrong.
No, it's right. You're right.
With the way you said it, I was about to. Okay.
No, it's B. Waiver of premium. If you become disabled, you don't have to pay you gotta pay your premium for 6 months though. Then they'll pay you the 6 months back, which don't make no sense. And then they'll waive your premium after that. So if you say you disabled in January, you still gotta pay your premium all the way through June. And then after June, you ain't gotta pay.
So
Got it?
pay premium for 6 months,
Yep, pay your premium for 6 months, and after that, you ain't gotta pay no more.
and that's for accidental incidents.
No. I ain't said nothing about no accidental.
I
Don't
mean,
have
not
nothing to do with
incidental.
that.
I'm trying to find the exact word that you said, but it's basically something suddenly happens, you'll still be covered because you paid a
If you
couple months.
if you become disabled, you'll be
Okay,
still covered.
disabled.
Right. I know the formatting on the slide is terrible, but you need to know a waiver of premium is disability rider. That's interchangeable. When you see waiver of premium, the answer is disability rider. If you see disability rider, the answer is waiver of premium.
Okay.
The accelerated death benefit rider allows the policyholder to A, receive an early payout due to terminal illness. B, convert term insurance to permanent insurance. C, withdraw cash value without penalty. Or D, extend the policy's coverage period.
A.
That's it. A, receive an early payout due to terminal illness. Let's go. Accelerated death benefit means they're going to pay it early before you die.
Good job, Nat.
Thank you.
Which of the following life insurance policies bills cash value? A, term life. B, whole life. C, accidental death. Or D, credit life.
Whole life.
That's exactly right. Whole life bills cash value. So you can borrow on the policy, and at your death, they subtract the loan from the face amount. That's whole life. Next, a universal life insurance policy differs from whole life in that it has fixed premiums, offers flexible premiums and death benefits, does not accumulate cash value, or is only available for a specific term.
Well, I would think the only thing that's different is probably building the cash value. See?
No, but they both bill cash
They
value.
both do.
The answer is B as in boy.
Oh, for flexible premiums. Okay.
Yep, flexible premiums. Universal life policies have a flexible premium, meaning premium changes inside of the policy every year. So whenever you see universal life, the answer is flexible premium. And if you see the word flexible premium in the question, then the answer is universal life. Is interchangeable. Got it?
Yes.
Got it.
Which type of annuity stops making payments upon the annuitant's death? A, life annuity. B, joint and survivor annuity. C, period certain annuity. And D, fixed annuity.
I would think A.
Yes, the answer is A. A life annuity pays for the life of the person or until they die. That's the same thing. That's what it says until annuitant's death. A joint and survivor annuity doesn't stop when the annuitant dies. It pays the survivor. That's why it says joint and survivor. So the husband dies, the wife keep getting paid. Period certain annuity means the annuity is going to pay for a certain period of time, like 10 years or 20 years. So even if you die, let's say if it's a 20-year certain, if you die in 8 years, your beneficiary is going to get a check for 12 more years. And a fixed annuity pays for a fixed, I guess a fixed period of time, even though that ain't really like fixed annuity could have a fixed annuity could have a certain payout period or life in annuity. That's kind of tricky. But the answer, because a fixed annuity could have a various payout options, but the answer is A. A variable life insurance policy requires the policyholder to have a securities license to purchase it. The cash value to be invested in sub-accounts. Fixed premium and guaranteed death benefit. No financial risk to the policyholder. Going once, going twice. The answer is B as in boy.
I had a feeling.
Whenever you see the word variable, it's synonymous with the word investment. So a variable life insurance policy has the cash value invested in sub-accounts like mutual funds. So if you see something about investments in the question, the answer is variable life. And if you see variable life in the question, investments is the answer. The primary advantage of a Roth over a traditional IRA are contributions are tax deductible, qualified distributions are tax free. It has no contribution limits. It is employer sponsored. Going once, going twice.
Is it A?
B.
The answer is B. Roth IRA has qualified distributions are tax free, meaning if you hold an account over 5 years, you can take your money out tax free. A person who is classified as a preferred risk will generally pay a higher premium, pay a lower premium, be denied coverage, have a graded death benefit.
Pay a higher premium.
No, it's the opposite.
A lower.
A lower. Preferred risk meaning you healthy and you in great health. The better your health, the cheaper it is. So preferred risk gives you
preferred risk.
preferred risk meaning you healthy. Let's say if the question said if a person has a substandard risk, substandard meaning you sick, basically, or have health issues that they're gonna charge you a higher premium. So preferred risk means good health and is lower. Substandard risk or rated risk meaning they're gonna charge you more. Got it?
Got it.
The MIB, Medical Information Bureau, is used by insurers to A, track criminal history, B, share medical information to prevent fraud, C, determine credit scores, D, issue insurance licenses.
B.
That's right. Everybody got just like the credit bureau shares your payment information, the medical information bureau shares your medical information. Which of the following is not valid underwriting factor for life insurance? Underwriting factor means it ain't got nothing to do with you getting no life insurance.
Good job, sis.
Hold on, I skipped the question. My fault. Let's go back. If an insurer discovers material misrepresentation, material means something dealing with some money, or they wouldn't have issued it. A material misrepresentation meaning they lied in an application after issuing the policy. They can adjust the policy benefits retroactively, cancel the policy within the contestability period, increase the premium after the policy is issued, deny claims indefinitely. The answer is going once, going
B.
twice. B,
B.
exactly right.
B.
B. Within 2 years, they can cancel it. Which of the following is not a valid underwriting factor for life insurance? A, credit score. B, age. C, occupation. D, smoking status.
A.
A, credit score is typically not used in underwriting life insurance. And the key word is typically not used, because if you get a policy big enough, they'll check everything. If you say you want $10 million policy or something, they want to know everything. They might even check it at $1 million. What does the term adverse selection refer to in life insurance? The preference for insuring only young individuals, the tendency for high-risk individuals to seek insurance coverage, the exclusion of pre-existing conditions, the process of adjusting premium rates.
C.
B, the tendency of high-risk individuals to seek insurance coverage. Adverse selection occurs when those most likely to claim a benefit high risk seek coverage. Adverse selection, the tendency of high risk individuals to seek insurance coverage. With adverse, I would have chose C too, because C to me sounds right. But I think adverse selection doesn't mean they're going to exclude you altogether. They'll still cover you, but you just might have to pay more. So that's why they're saying high-risk individuals seek coverage. They're not necessarily excluded. But that could be a little tricky. The primary purpose of the State Guarantee Association. A, ensure all policies are profitable for the insurer. B, protect policyholders if an insurer becomes insolvent. C, regulate agent commissions. D, approve new insurance products.
D. No, wait.
Going once, going twice. The answer is B as in boy. Protect policyholders if an insurer becomes insolvent. Basically, if the insurance companies go out, every insurance company got to pay money to do business in any state. And if the company goes out of business, then the state will cover their claims. So let's say if an XYZ company was doing business in Georgia and they went out of business, all them people had them policies in Georgia ain't gonna lose all their money. The state of Georgia gonna cover those policies. The state of Georgia Guarantee Association is gonna cover those policies. Got it?
Got it.
Got it.
Almost done. Which law requires insurers to provide applicants with a buyer's guide and policy summary? Fair Credit Reporting Act, McCarran-Ferguson Act, NAIC Model Regulation, Life Insurance Disclosure Act.
D.
There's it, Life Insurance Disclosure Act. D is in David. Good job. 6 more. An insurance agent is considered a fiduciary because they set premium rates for policies, represent the insurer, not the client, handle client funds and must act in their best interest, or change policy provisions. Going once, going twice. A fiduciary means that they're acting in the client's best interest. I don't know why they put that part on there about handling funds, but they're acting in the client's best interest. That's the definition of a fiduciary. So even though the insurance agent represents the company, he's supposed to act in the client's best interest. A twisting violation occurs when an agent replaces an existing policy using misrepresentation, sells a policy to an uninsurable individual, fails to disclose commissions to the policyholder, issues a fraudulent death claim. Going once, going twice. Twisting is the unethical replacement of life insurance. The answer is A.
Oh, sorry.
The free look period in a life insurance policy allows the policyholder to change the beneficiary, cancel the policy and receive a full refund, convert the policy to another type, reinstate a lapsed policy.
B.
That's it. B, cancel the policy and receive a full refund. The spendthrift clause prevents a policy beneficiary from A, assigning or borrowing against the death benefit. B, changing the policy ownership. C, receiving dividends from the policy. D, contesting the policy provisions. The spendthrift clause prevents a policy beneficiary from A, assigning or borrowing against the benefit. B, changing the policy's ownership. C, receiving dividends from the policy. Or D, contesting the policy provisions.
Is it A?
A, assign or borrowing a death benefit. Let's go. Good answer. A level premium means the premium stays the same throughout the policy's term. B, the death benefit increases over time. C, the premiums are lower in the first few years. Or D, the policy expires after 10 years.
A.
The answer is A. What does the term non-forfeiture option refer to? The insured must forfeit coverage if they miss a premium. Benefits available when a policy lapses. A guaranteed death benefit increase, or the policyholder's right to dividends. Okay, going once, going twice. The answer is B, benefits available when a policy lapses. So let's say if you got a whole life policy, so you got to remember non-forfeiture options only apply to whole life policies because whole life policies have cash value. So if this policy is lapses and you don't want to lose the cash value or you don't want to forfeit the cash value, these are the options you have available. They are called non-forfeiture options. The answer is B. Which of the following is not a settlement option? A, lump sum. B, interest only. C, life income. Or D, annuity certain. Going once, going twice.
B.
The answer is D, annuity certain. Settlement options meaning that insurance company's going to pay out the death claim. They got 5 options. The acronym is CLIF that they can pay. They can pay cash all at one time. They can pay life income, basically an annuity for the life of the beneficiary. They can pay the interest only. They can pay a fixed amount or a fixed period. So the answer is D, annuity certain is something different. All right, family. Thanks for hanging in here to the end.